Hello everybody, this is Eitan Rotem, November 28, 2018, with a special episode for the recent Nasdaq revival. For those of you who are new here in my channel, let me just say that I have a degree in accounting and a master's degree in economics. I've been active in the stock market since 1987, that's right, that very year of the big crash, when I was still young, ignorant, and reckless, and of course I couldn't notice, and actually I wasn't even aware of the negative divergence nor the negative divergence concept to start with. The negative divergence just hit the market in August 87, 2 months before the big crash, and I was of course a victim because, as I said, being young, ignorant, and reckless, and I could not see the spot there because I was blind, and when you're blind you just can't see. How could I not see it? You can't see when you're blind, and unfortunately 95% of the investors in the market are blind, either of ignorance or just looking the other side. Bottom line, if you're ignorant and are not aware of market red flags, or you are ignoring them out of whatever reason, you're condemning yourself to be hit by the market over and over again. Since the year 2000, my firm has been managing private funds, gaining especially high returns during the bear cycles of 2000, 2008, and 2011. And as a matter of fact, bear cycles are one of my expertise, including also insiders, hidden hints, methods, and exponential position sizing methods. All of these methods provide me with a long-term consistent edge which lead to exceptional results. I believe that a killing edge plus compounding lead to success. However, much better than that is a killing edge plus the 20-80 principle plus compounding plus time, that together lead to huge success. And by the 20-80 principle, I mean that 80% of the time we are actually observing and waiting for the real hunting to be taking place in that 20% of the time. You see, every year, each and every year, are on average 4 good cycles and 4 bad cycles. If you are trying strategically to avoid the 4 bad cycles, you are avoiding decompounding your returns. That means that in the long run, short-term success will compound itself in just a matter of 5 or 6 or 7 years to phenomenal success. Having said that, let's see what we've got today for main dish. And the main dish today is Nasdaq on focus. As I said before, 3 things. Number 1, you can see the decay of the negative money flow in the QQQ, which is the ETF of the Nasdaq 100 index. You can see that mid-October there is a low here, and mid-November there is another low, a lower low. However, you can see a higher lows between these 2 points in time in the Rotem money flow, which means that in both points the Rotem money flow is negative. However, it's less negative in the second point, which means that the amount of potential selling is decreasing seriously, decaying, and therefore paving the way for at least 1 month of revival / recovery, whatever. Why 1 month? Because we can see that the bandwidth of this positive bullish divergence is about 1 month, a little bit more than 1 month, but this is on average what we're expected to see during the coming unfolding month. Another positive divergence that we can notice is the advanced decline volume of the Nasdaq versus the Nasdaq index itself. You can see the lower lows of the Nasdaq index and the higher lows in the advanced decline volume diverting from it. And the third one, which is not of less importance, is the QQQ's implied volatility also diverting from the historical volatility. Let me explain that. For those of you who don't trade options, it's imperative. Options are actually priced according to the level of panic or euphoria that investors are feeling at a given moment. So you can see the blue line here, which is the historical volatility. The actual volatility of the Nasdaq is going up to a new high recently, but at the same time, the implied volatility, the orange line, is going down, which represents a declining willingness of options buyers to pay premiums actually for the insurance against more declines in the market, which means that there's not a lot of panic in store for the Nasdaq right now. There are actually red flags or green flags, if you may, give us a good hint that the Nasdaq is going north for about the next month or so, give or take 1 week, and there are several strategies that we can implement during that month. But also we need to understand the context of that 1 month, give or take 1 week, in the bigger picture and what it means for the year 2019. Just to start with, we can see 2 areas of overhead resistance in the QQQ. We can see that the first area is just ahead of us, around 168 to 174, maybe 176. And then another area laying between 180 to 186. There is a counterintuitive play in action here. Play number 1 could be that the Nasdaq is going to face a serious resistance here within the first area of 168, 174, 76, and stay for a while here. This could be considered obvious that the market will struggle a little bit in the first area of resistance. It's actually previous point when he tried to recover early November and failed. So it's actually a retest, and a retest could be either a failure or a success. In the obvious scenario that it will hit a wall within this area and then succeeds to penetrate up the 176 mark, it is also obvious to expect that it will have a relatively tougher life in the upper 180 to 186. This is not true at all, because if it takes some time for the QQQ to digest that level and then penetrate the 176 up, resistance in the area of 180 to 186 will then be older and with less importance. So what's counterintuitive here? The counterintuitive is that if it struggles in the first area, it will have lighter life in the second area, and vice versa. If it's gonna have a lighter life in the first area and it's gonna penetrate it smoothly, then it's going to hit a wall in the second area. However, the important thing to take from that is that there is a commonality of these 2 scenarios, which is, in any case, Nasdaq is going to face some serious resistance either here or there, because Nasdaq right now is just a product of both the financial and psychological damage it produced during the last 2 months. So it's going to be tough life for the Nasdaq anyway. This is crucial to understand, because if you look at the bigger picture, you see and you understand that this is a critical point. This is only the 8th critical point since the low of 2009. You can see that I've marked here all the instances during which the MACD of the QQQ hit the 0 or under the 0 since the low of 2009. You can see that once in 2010, twice in 2011, once in 2012, once in 2015, and twice in 2016, and also now. This is the 8th time. Please pay very good attention to the fact that all of these lows in the QQQ are in an upward order. It means that none of these previous 7 points has been penetrated to the south side. all of these previous 7 points were respected by consecutive points. Also now you can see that the 8th point, the low that we're witnessing right now in November, is respecting previous points in 2016. But, and this is a very important but, should this low point be broken and not respected, this could be a sign for the beginning of a very powerful bear cycle. Very powerful bear cycle. You can see that there's no place to hide here. There's a lot of space to fall into. It's just free air. You can have all that free fall here. It's not literally free fall in just one day. It's never happens this way. But a bridge underneath the low of November could produce multiple waves of free falls. Bear that in mind during the upcoming month. So what kind of plays we can produce in a scenario like this, in an environment like this? You can look at assets that have a distinctively different formation and attitude as the QQQ or the spiders, which means, for instance, the XLP, the Consumer Staples ETF. You can see that it has higher highs early November versus September. This is opposite to the behavior of the QQQ and spiders. You can see also the Rotem money flow plays very differently from the biggies. You can see a higher Rotem money flow recently in November than it was previously in September, which means a very healthy advance. This is not a smell of gasoline. This is the real gasoline for energy. So this ETF is actually fueled with real gasoline and it can advance. Let me just emphasize again that this is just a short-term play for the upcoming month or less than that. This is still a transition period during which the QQQ and the spiders and the Russell and the Dow Jones and the rest of these guys will decide upon the next big cycle. Are we entering a severe bear cycle, or is it a revival and recovery and going back to the arms of the long cycle? For me, I play no favorites. I'm just the humble servant of the market. Whatever the market decides, I will just play that game with no hesitation, with no second thoughts, with no second guessing myself. Just be obedient to what the market dictates. So XLP and the likes that look much better and fundamentally different than the broad market are a good long play for the short run. A better play still, an asset like Alibaba, which you can see that at the bottom has a positive divergence, and then the Rotem money flow turns from negative to positive, and it's been consolidated for almost 2 months, and then penetrates the 30-day high above this area that could be described as the most difficult resistance area. Again, you can play that for the short term in a long position, taking BABA, buying BABA, and placing your stop here at about 142, or alternatively, and preferably for me, because Alibaba is not in a very distinctive positive structure as I showed you with XLP. And so I would prefer to just sell out of the money, put options inside this area of 138, 135, and so on for the next couple of 2 to 3 weeks, putting in my pocket some 2 to 3% for that period of time, and just see these options expire in that narrow window of time. I would much prefer playing that, squeezing play than to take a long position with Alibaba, given both the very slow trend of Alibaba and the overall market environment. So thank you very much for listening to me and taking notes very cautiously. And I wish you all the good luck in your trading and see you soon.